Hello and welcome to our latest Insider interview. I'm Kyle Caldwell, and today in the studio I have with me Alex Wright, Fund Manager of the Fidelity Special Values Investment Trust. Alex, thank you for coming in today.
Thanks for having me.
So Alex, you invest across the UK market, but you do have a long-standing overweight position to UK mid-cap and UK small-cap stocks versus the FTSE All-Share. Could you explain why the fund is structured in this way?
Yeah, so you're right. The fund can invest in anything quoted in the UK and actually up to 20% overseas. And we're using about 11% of that today, so actually a bit below history. The reason we invest more in mid and small caps, so which is about 60% of the fund, is there's just more choice there in the market. So the UK market's quite concentrated when you go up to the top 10, top 20 companies. So there might not be many companies to choose from. Whereas if you actually look at the investable universe, there's probably about 1,000 companies to choose from. The added advantage as well is as you go down the market cap spectrum and start looking at those 1,000 companies, there's many less other people looking at them. And so the chance of finding something uncovered, misunderstood is that much more as you go down the market cap spectrum as well.
You mentioned that you have around 11% in overseas companies, which is lower than usual. So what is the typical exposure and why have you been reducing overseas companies?
So we've been as high as 20 actually, and we've regularly been above sort of 16 or 17%. And that tends to be in both European and US companies, which are covered out of London by the Fidelity analyst team, which is really key to the process, compared to Asian companies, which tend to be covered out of Asia. It's primarily that we don't own any US companies anymore. So they would have been 6 or 7%. Actually, at one time, maybe up to 10% if we go all the way back to sort of maybe 2012 when we took on the trust. But today, I've just found it very difficult to find any value in any of the US companies, even in unloved sectors like banks and old tech, which were some areas that we did use to invest in the US. So today, we're primarily just in European companies. And actually, most of that is actually in Ireland, which I count as largely another sort of home market. It's obviously right next to the UK. The economy is actually very dependent on trade with the UK. So it's more like an extension of the home market rather than sort of being truly abroad like the US or mainland Europe would be.
And when did you reduce that US exposure? Was it a more recent move or has it been gradual over the past couple of years?
So it was more of a sort of gradual thing. So it's when companies sort of worked, we sold out of them. So some of the big US positions were like Electronic Arts back in 2012, and that did very well. We maybe sold that in 2015, 16. Citigroup was at one point actually the biggest position in the fund, was 6% of the fund. We sold that in 2020. So it's sort of been a gradual process where actually that percentage has been going down. And then more recently, like Schlumberger was the last US position that we sold maybe 6 or 7 months ago.
Moving back to these shores, so within the UK mid-cap and small-cap part of the market, are there any particular sectors that stand out for you or any particular types of businesses?
So I think the type of investment we look for, sort of undervalued companies that are misunderstood, can be present in any sector. But we have generally focused on some areas that I think have been consistently misunderstood. So financials has been a big weight over time. And certainly until recently, particularly banks were really out of favour. Actually, at the margin, maybe more people are waking up to sort of banks being good businesses, producing good earnings. So if anything, we've reduced that area, but we still are overweight, also including sort of insurance, some real estate companies, some other financials. But we really do sort of invest across absolutely everything.
You are a UK value investor. Could you talk us through the key ingredients that you like to see in an unloved business that you then hope will recover over time?
So this company being cheap is clearly the first thing we look for. So companies that are unloved and where an issue either on a sector level, or so in the industry that the company operates in, or at the company itself, is clouding people's judgment about sort of why this is actually a valuable company. So often that is short-term financial performance is poor, and we think it can turn around. And it's that working out what will turn it around, what will be the catalyst, that's really key to the process. So we don't just buy cheap companies in the hope that they turn around. We're not just a sort of classic deep value screening fund. We do a lot of work meeting the companies, meeting the competitors of those companies, suppliers, talking to industry consultants, using the broad analyst team at Fidelity to really work out actually what's changing and why will this company be valued more highly in the future. So avoiding sort of value traps, effectively companies that are cheap but stay cheap.
And to illustrate the way in which you invest, could you provide an example of a company in which you bought when it was unloved and then it went on to recover?
Oh, so there's loads of companies that have worked in the fund. I suppose looking at something that we've been in until recently, Barclays, in the banking sector, so clearly an unloved sector. Also their business model somewhat unloved, that they do investment banking and retail banking, but where we sort of saw actually some quite strong franchises, an ability to get returns up, a management team that was sort of motivated to do that, and also a reduction in competition, so that exits of some investment banks like Credit Suisse, exit some of the challenger banks like sort of Virgin disappearing in the UK. So that's classic to what we like to see, both sort of change happening in a company, but also in the industry where the company operates. And that stock has done very well, actually. It's up about 100% just over the last 12 months. And so while I'd say the company isn't exactly expensive, it's much more appropriately valued than it was when we invested.
And what is your typical holding period for a company? Do you have a certain price target, and then once that company hits that price target, do you then look to sell and put that money to work in a cheaper company?
Yes, we very much do. So we tend to think, what can this company do on a 3 to 5 year view? So I think the market is quite short-term focused. So often it's asking what's it going to do on the next sort of 6, 12 months, whereas we're sort of thinking actually what's going to happen over 3 to 5 years. But often, if that 3 to 5 year view actually starts to play out, you don't often have to hold for the whole period, because the market sort of gets excited about the turnaround coming through. People tend to pay up for that ultimate 5 years a bit ahead of time. So I'd say our average holding period is more like 3 years. So the turnover of the fund would be closer to sort of 33%.
As well as aiming for long-term capital growth, Fidelity Special Values also pays a dividend. The current yield's around 2.8%. So how do you structure the portfolio to deliver both capital growth and income growth?
So we're very much looking at sort of total shareholder return. So what can a stock deliver in terms of sort of total return over that sort of 3 to 5 year time horizon? Sometimes quite a bit of that will come from the dividend yield. So a great example of that would be Imperial Brands, which has been a great contributor to performance. A lot of the 5 year performance has come from the fact that that's had a 10% plus dividend yield, but then we've seen capital growth on top. Other times, companies won't pay a dividend at all, but I think there's very attractive capital growth. So again, there can be changes in the dividend paying ability of the fund. What the board looks to do is keep my mandate unconstrained. So where the absolute best opportunities are, that's where we invest, even if sometimes they're coming from dividends, sometimes they're coming from capital, and then always try and hold back as much income as possible, so that actually, if dividends have gone down temporarily in the portfolio, a bit like they did in COVID in 2020, we have the ability to actually maintain a dividend, which is what we did then. As you look at it today as well, the underlying portfolio yield for the actual companies we own is much more like 4%, but then we do take fees out of that income as well, which is why the dividend yield of the trust is actually lower than the underlying portfolio.
You don't have any exposure to the two large cap oil companies, Shell and BP. These two companies, you typically see them in the top 10 holdings of a lot of UK equity funds, particularly those that are also aiming to pay a dividend. Why don't you own this duo?
So I think we have owned a big position in Shell, and we sold out of that the back end of last year. And indeed, there was a point in 2020 when Shell got to be the biggest position in the fund, because we were very excited. It was about 6% of the fund at the time. And obviously, particularly in, I guess, the sort of 3 to 4 years running up to COVID, oil was a very out of favour area. There was a lot of people who were divesting for sort of ESG reasons. There were also talk about sort of peak oil and EVs growing sort of very rapidly, and actually therefore demand going down. So it was a very out of favour area, and the large caps and the small caps were all attractively valued, and I thought of BP and Shell was much more attractive. Now I think obviously since then, obviously seen a much higher oil price, a much slower growth in actually the electrification of car fleets than was maybe anticipated. And actually the lack of capex investment from the majors actually reducing some of the production growth that was maybe seen. And so for oil's come much more back into vogue as an investable sector. But I think most people haven't had the confidence because, again, they probably haven't looked at oil for a long time because it was out of favour to actually go down the market cap spectrum, and they've tended to sort of stick with just those big majors. So actually, I don't think the valuation of BP and Shell looks particularly good. And actually, through history, this is a commodity sector. So the returns available from these companies aren't actually that good. So you don't want to own the stocks when they're in favour because these aren't great companies over time. They're largely cost of capital, maybe, unfortunately, particularly in BP's case, sub cost of capital. So they haven't produced economic returns. They haven't produced the sort of the 10% return on capital that we'd hope a company would produce. So actually the longer you own that type of company, the worse the returns will be. So we've tended to focus our oil investment in smaller cap companies, particularly Energean would be the biggest small cap position, or companies that are a bit more out of favour. So we actually have a 2% position in Total. And I think that's actually a business that, again, there's a bit more ESG investment still in Europe. So again, investors there have been more wary of investing, particularly because of they do operate in Africa, which is obviously geopolitically trickier. And then also because the French market has been out of favour, particularly around sort of some of the political issues that are happening towards the end of last year. That gave us the chance to move the final part of the Shell position into Total.
Alex, thank you for your time today.
Thank you for having me.
So that's it for our latest Insider interview. Hope you've enjoyed it. Let us know what you think. You can comment, like, and for more videos in the series, do hit that subscribe button. And hopefully, I'll see you again next time.